How to beat the mental game of trading using science. Now, before we get into this video, I'm going to play for you a clip from Jim Simons, this man right over here. He's considered the king of the quants, and he did 62% per year, averaged out over 33 years, meaning he is one of the top performers across all of Wall Street. And he did it using one key principle.
If you're going to trade using models, you just slavishly use the models. You do whatever the hell it says, no matter how smart or dumb you might think it is at that moment. And that turned out to be a wonderful decision.
Now, this is the principle I want to get across in this particular video. And the reason I want to do it is I was just sitting here and I was looking at another post on Twitter that simply was saying, everything about trading is just discipline and you just need discipline and you'll be perfect. And honestly, it drives me absolutely crazy. Everyone talks about discipline like it's some magical cure for all of trading psychology. You just need to be disciplined. You need more discipline. Discipline is everything. But here's the brutal truth most people won't tell you. And that discipline is just a fancy word that covers up millions of mistakes. Think about it just for a second. If I told you that every time you flipped a coin, you would win $4 for heads and only lose $1 for tails, would you need discipline to keep flipping that coin? Hell no. You'd flip that coin all day because you know the odds are in your favor. The problem isn't discipline, the problem is conviction. And the thing is, most traders are trying to force themselves to follow strategies they don't actually truly believe in. And why would they? They have no proof normally for that strategy at all. They're white-knuckling through trades, hoping their discipline will carry them through the uncertainty of trading. But uncertainty plus a lack of conviction normally equals trading psychology disasters. At least that's how it was from my own experience for the past 5 years of trading. To that note, I've been algorithmic trading for almost 5 years now. I think total time I've been trading, I've been about 6 years, give or take, just coming up. And I've backtested hundreds of strategies over that time. Here's what I've learned about the real mental game of trading over all those years. Conviction comes from three things. We're gonna talk about each one here. So the first one is data that you trust. Not some random backtest that you found online, but data that you've verified. There's a classic bias called the sunken cost fallacy. And it's meaning that the more time you put into something, the harder it is for you to really basically let go or move on from it because you put so much time and effort into it. Now, this can actually be a burden or an issue in some cases, but I do think in a lot of times in trading, you first need to at least put in some hard work of backtesting that strategy, spending the time, whether that be coding it, getting enough historical data for it, doing different sort of tests that we'll also mention in just a second, because that time and effort that's gone into it will make you have more conviction in it than if you just bought it off the shelf or you just found a random idea and then didn't test it at all and just put it straight live. Because I can tell you from experience, the first trade you'll place on that, you'll start second guessing yourself. Probably your first thought will be, well, I just found this online. How do I have any idea that this is going to work? And now I'm risking live money on it. So you do have to put some effort and data behind it first so you can actually have some proper conviction. Second is you want a logical reasoning. You want to understand why the strategy should work, not just that it's worked in the past. Now, I have some other videos on this particular topic going over like risk premiums and inefficiencies, but I'll just give you two really easy ones here. Trend following, where you're basically catching trends on the long side mostly, also I guess on the short side as well. That has been a strategy that has worked consistently for over 30 years. Funds have used it, retail have used it. There's been many traders that have made amazing trend following strategies around it. It's a very simple principle, and there's many reasons of why it should work because it's collecting a risk premium basically on equities or whatever the underlying is you're trading. Another example that I commonly give on this channel is arbitrage, because arbitrage is what I like to think is the most pure example of how someone can understand trading. And a classic example of arbitrage is if you are buying it from one exchange and then selling it on another exchange that had a higher price. So let's say exchange A was listing it at $100 and exchange B was listing it at $110. There's a $10 spread there, and it's very easy to understand that if you buy it on A, sell it on B, you'll make $10. You can clearly see why that's something that would work. Now, the last one is proper testing. You want to do parameter sensitivity, Monte Carlo simulations, out of sample testing, the works. Now, I have videos, I believe, on every single one of these techniques, or at least just an overview of them. And this kind of pushes you beyond just the standard backtesting. And it definitely pushes you beyond anything that maybe if you're just doing manual backtesting and looking at a chart, which in my opinion, I wouldn't really consider solid and scientific backtesting. You want something that's ideally coded, and you want normally at least a couple of years of historical data, depending on sample frequency, and then you want to do these tests as well. Let me just quickly get rid of this box. Now, when you have real conviction built on a solid foundation, you have a lot less doubt than if you had no underlying reason or data to back up your strategy. Just to give you a small story from that, when I first got into trading, it was in the first year I was introduced to the strategy that would first kind of make me a decent amount of money from trading. That was small cap, which was basically shorting companies that were a small market cap and were gapping up hugely on the day. Now, when I first was introduced into it, I had a lot of execution issues. The main reason being is I had heard the strategy from a chat room I had bought and the classic first year or so. You're buying chat rooms, you're buying alerts, those sort of things, right? And I'd heard it from one of those, and I thought it was kind of interesting. There was a lot of volatility, and that made me think, hey, I could probably make a lot of money on this with my small account. Now, when I had no data behind it and I didn't really understand why it was working, I messed up every single trade. I'd either hold trades way too long or way too short, or if something pushed against me just a bit, maybe I'd average down even more onto it. All the classic execution mistakes. But once I finally actually backtested it, I understood why it was working. I understood when it was going to work the best, at least historically. That's when I could actually start to consistently kind of gain profits from the small cap space. But look, I'm not saying that conviction is going to eliminate all emotions. Trading, there will always be some element of emotions. And I think that's just because you're messing with money. And for a lot of us, especially if you don't come from money, that can be very difficult to see that sort of fluctuation or variance and handle that uncertainty. Drawdowns are still going to suck. Losing streaks are still going to sting. But what I've learned from my personal experience is being in a drawdown while trading discretionary is a whole lot more scary and more likely to mess up your next trade, and probably worse in the drawdown. Compared to being systematic about it, which I've had my past 5 years of experience of being systematic and algorithmic, handling a drawdown nowadays just feels like typical trading. I actually probably talk about drawdowns a bit too much. I think a lot of people think it's kind of the boring part of trading, but 99% of the time you're going to be in a drawdown. You're not going to be at all-time highs. So you have to understand how to handle them, how to logically think about them, etc. Now, when I was trading discretionary, a bad day would spiral most often for me. So I'd be thinking my analysis is maybe now wrong. Should I change my strategy? Did the markets change? Does the strategy no longer work? Do I need to tweak something? But now with systematic trading, I'm thinking that this drawdown is within my Monte Carlo projections, which is basically just a test of resequencing the trades, the historical trades from a backtest. So you can see how much extra variance there could be based on your drawdowns or your returns, etc. I'm also thinking that I have 500 plus trades to back up this particular strategy. So having one losing trade or a couple losing trades or even a drawdown, I'm not overly that worried. And the most important thing is the next trade will always follow the same criteria as always. I wouldn't be trading systematically if the next trade after a losing trade, I'm instantly changing the criteria. That's not what systematic traders do, and that's definitely not what Jim Simons did with his particular strategies. So the difference isn't that conviction makes you emotionless, it's that conviction gives you something to lean on when your emotions try and take over. And that's why I gave that example of the coin toss up ahead. It's a very simple thing to understand that, on heads, if you get $4, and on tails, if you're losing $1, and for the most part, a coin flip is 50-50. But keep in mind, when you're flipping that coin, you could get tails maybe 7 times in a row, 8 times in a row. But are you going to be that worried? Probably not, because if you finally get heads, which, statistically over a long enough sample size, you will get heads at some point, you're going to make $4. And then you'll keep on making $4 on any extra head. And that's what I'm saying, is that when you have data behind it and you have more conviction around it, that's something you can lean on. You can lean on that data and say, well, now I'm in a bit of a drawdown, but historically it's lasted this amount of time, or I've had this many drawdowns, etc. The struggling trader often thinks this feels wrong, and maybe I should skip the next trade if I just lost the previous trade, or something's maybe trading a bit differently. But the systematic trader is saying this feels uncomfortable, but my data says to take the trade, and that's why I'm taking it. Both feel the same discomfort. Only one has evidence to actually guide them through it. So when you truly believe in your edge, the mental game becomes a whole lot easier. And that's what we also talk about on the podcast, Systematic Shenanigans, is that once you have data and you truly understand why your strategy is working, you will still have losing trades, you'll still have drawdown periods, they'll still suck, but they'll not hurt as much because you'll have something to lean back on.